Hello, welcome to this episode of Rich Insights. I'm Don Rich, head of investments for Esoteca Capital Markets. Today's topic is on relative valuations, right? What's rich, what's cheap? Now, we've had a nice bounce since the March lows. So the question to be asking ourselves is there any low-hanging fruit remaining? All right, so let's immediately go to the charts. Here we got value versus growth. So this is 1 unit of growth price in terms of 1 unit of value for the S&P 500. All right, so you can see this index, the series is indexed to 1 in January 1996, and we can look at it through time. All right, so the index peaked during the dot-com bubble, and you can see where we're at today, the most recent observation here, April 17th. We're near the all-time highs. Oh, shit. We remember what happened during the dot-com bubble. That suggests we should get out of growth, right? Wrong. Let's keep moving. I'll come back to that. Here we got small caps versus large caps. All right, so this index is set up such that small caps become cheaper on the lower end of this axis. So we can see the series had an all-time cheap level for small caps during the dot-com bubble, and we're getting closer. We're getting closer. It's not as close as it was during with the value and growth chart, but it's certainly getting closer. It looks like small caps are cheap. It looks like value is cheap. Looks are deceiving, people. That is wrong. That is wrong. All right, now let's just stop and think why that is. For the last few years, the U.S. equity markets have been outperforming. All right, during the final years of the bull market, why did the U.S. outperform? Because of tech. All right, the U.S. has the highest allocation of tech, and tech was doing well. Now, during the first quarter of the bull market, what sector was the top performing sector? All right, during the pullback, what was the top performing sector? It was tech. So during a bull market, tech behaves as an offensive play. During a bear market, it behaves as a defensive play. Why is that? Why is that? Well, of course, we're a tech-based society, and we're becoming more and more tech-based, right? That's first thing. The second thing, though, is they have pristine balance sheets. They are sitting. Most tech firms are sitting on a ton of cash today, and they're generating cash like mad. All right, it's called free cash flow. It's the cash they generate in excess of their operating expense. And finally, they have very small debt burdens. That's a pristine balance sheet. That's why they've been outperforming. So if you listen to the boneheads that tell you to switch to value for growth or switch into small caps, you have to realize that means that you're going to be leaving tech. And I think that's a very bad idea. So what is, are there any good ideas? Let's go back to the charts here. Here we're looking at utilities relative to the S&P 500. All right, and what we can see here is that utilities have outperformed the S&P 500. All right, for the last 2+ years, utilities in general have been outperforming the S&P 500. So you would think after that lengthy period of outperformance that its valuations would be expensive as hell. But they're not. Look, we're sort of right in the middle of this chart right now. All right, I like that a lot. I like that a lot. So if you're looking for low-hanging fruit, those are suggesting value over growth. That's probably the most popular one. I just think those people, I just don't think their cornbread is cooked all the way in the middle. You know what I'm saying? All right. So I'm not a favor of value over growth right now. I'm not a favor of smalls over large because I don't want to dump tech. But picking up some utility exposure makes a lot of sense to me from the relative valuation standpoint. All right. So that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed this. May your beer be colder than the company you keep. We'll talk again soon. Thank you.